Hello, everybody, and welcome to our Moving Markets monthly update. I am Michael Schneider, and as always, I'm joined by JR Gondek. And today we are going to talk about what we saw in March and provide a bit of an update on what we see moving ahead. JR, I think looking at this first quarter of 2021, we've had a really strong start overall. I think a lot of that has been driven by a lot of the stimulus payments, and we've seen a lot of new infrastructure bills kind of come to play. We've seen rising incomes, and we've had a lot of good news really in terms of economic data come across our desks. Now, with that in mind, I do think there's going to be some bad news that kind of, we have things we have to watch out for. And if we dive into things, we look at jobs and we look at unemployment from March. We added about 900,000, a little bit more than that, new jobs this month. And from an unemployment perspective, we're still at around 6, but we thought we might have been closer to 5. Can you provide a bit of context to that?
Well, the data in March was very, very good. I mean, seeing over 900,000 jobs, we haven't seen a number like that since last year. And it's a great sign as we look ahead. The other thing that was interesting is the labor force participation, meaning a lot of people that weren't in the unemployment numbers came back in a big way in March. And of the 900,000, another good sign, 75% of those were women rejoining the labor force and getting jobs, which is a great, great sign because unfortunately, women were the hardest hit. And if you think about why, it was impossible to be a mom, teach school at home, and do your job. So unfortunately, women took the brunt of a lot of that. Having said that, looking forward, it's a great sign. Hopefully this trend continues, but overall was a great number and a great sign ahead.
That's good. That's good. And as schools reopen, getting kids back full time, how are your kids adjusting?
Well, my kids start back on Wednesday, which will be great. I mean, it's been over a year. They'll be full-time regular schedule. My 3-year-old, she started preschool. And of course, she, after 3 days, got a cold and was sick. So for all you pediatricians listening, I think business will be strong ahead.
Oh, we hope so, but hope all the babies and all the kids are okay. And, as we see everybody going back to work, we're also seeing from the different stimulus packages that have been pushed through that incomes have been increasing from the direct payments to individuals. Now that's just fueling a lot of spending, but that's on the individual and on the consumer side. On the government side, we're seeing the different infrastructure bills that are being pushed that we're looking at around $2 trillion in different infrastructure plays. Can you talk a little bit about what we would expect to see from those types of figures?
Well, if you look, we've been talking about this for many months, is the inflation concern. And with all the spending and income, it's great for everyone. But if you look, for example, the ship that was blocking the Suez Canal in March, we still haven't adjusted from the supply chain of the COVID shutdown a year ago. So there's still a lot of issues and there's a shortage in many different industries, whether it's cars, whether it's houses for sale, you name it. And it's just a very inflationary environment where all of us generally have more income than we did a year ago, but we're all competing for the same goods. So prices are up in so many different items overall, and it's something to watch for in the inflationary environment, even though we're not likely to see it in the government statistics. But we all can talk about it and see it, and it's something to watch for ahead.
Absolutely. And I think as we look ahead, we do want to provide a bit of perspective to the types of returns we saw in the markets back from last year and sort of what we've seen so far in the first quarter this year. So when you look back at last year, we had, obviously the pandemic was terrible, markets plummeted all across the board on the beginning of the year. But as you got towards the end of the year, you really saw, as illustrated by this graph here, where the growth companies significantly outperformed the value stocks. And in this graph, we have the Vanguard ETFs for our large, mid, small, and international companies. And you see the growth ETFs in blue. Those are up, far and away more than the value stocks in the tan that are, flat to down on the year. Now, this rotation we started to see was towards the end of the year, started around November, and has really gone into this year. And if you look at so far the first quarter this year, it's really the opposite story where the value stocks have drastically outperformed the growth stocks. And I think we see this as a rotation out of the large growth, out of the big tech into some of the more value type companies or the high dividend payers. So JR, what do you think about that shift? Is that something that we should look at as a big movement, or is this just a trend to be monitoring over time?
I think these graphs just illustrate how important it is to be diversified. Because as you look to last year, if you weren't in growth stocks, you probably didn't make very much for the entire year. Having said that, the rotation Michael's illustrating is real in the first quarter. And as we look ahead, it's probably the best risk reward we see in the markets overall are the value and dividend stocks. For example, we've been talking about 2021 being a record year for dividend payments. And it's illustrated again this month by the Federal Reserve allowing banks to increase their dividend payments in July. So that'll return a lot of cash to shareholders, and dividend and value stocks have performed very well in the first quarter. And the key as always is we stay very flexible with allocations, because if this trend continues, you want to continue to take some profit from your growth and rebalance. It's never advantageous in our opinion to be 100-0 and be all in value or all in growth. But the key is to have that flexibility to maneuver for the markets, and it's what we maintain.
Okay. And as we monitor these figures and these trends ahead, I think a couple other economic data points to continue to monitor are the long-term interest rates as well as inflation. In March, we saw the 10-year Treasury hit about 1.75%, which essentially doubled where it was earlier. And we're also seeing issues with rising inflation. Now, historically speaking, in a rising interest rate environment and having some inflation has always been a sign of a healthy economy. Can you explain why that might not be the case this time around?
Well, near term, so we believe we're in this good news, bad news environment where the good news is going to be very good on the economic front. But the bad news from the market perspective alone will be we're coming to the end of the Fed stimulus. So meaning the stronger the economy is, the sooner the Fed will stop accommodating and printing money every month, slow that down. And the sooner we'll get to long-term rates have moved up, but the Federal Reserve controls short-term rates. The sooner we'll get to a period where the Fed will raise short-term rates. And that's kind of that good news, bad news. That as we go out a few quarters, it's very good to be a healthy economy and markets that could stand alone without the Fed. So it's just a matter of getting to that period, the market adjusting off the Fed stimulus into a normalized interest rate environment. And it'll just take a few quarters, but near term, it could be a little bit of bad news, even though long term, it's very good.
Okay, well, speaking of more good news, we've already administered about 165 million doses of the COVID vaccine, which is a fantastic number. And we hope that we can continue to flatten the curve and return that sense of normalcy. And as we do, and I hope everybody's able to enjoy some of this nice warm weather we've been having. Don't forget to wear your sunscreen, as we all haven't been outside in over a year. And thank you all for joining us, and we look forward to seeing you next month.
Thank you.
Thank you.